Welcome to the Making Money in Multifamily show, where we discuss everything to do with multifamily real estate investing. We believe it's the best way to gain financial freedom and build lasting wealth. This is where you'll find the best information and practices to help you succeed in your real estate business, whether you're already experienced or just starting out. Here's your host, Dave Morja.
Hello, listener, and welcome to the show. I'm your host, Dave Morja, and today's guest is Rob Beardsley. Rob, welcome to the show.
Hey, thanks for having me back on.
Yeah, and for the listener, if you haven't heard of Rob on our show yet, he's sprinkled on throughout at this point, episode 3 all the way back to way back in the day, and then we've been doing the Between the Sheets series, so if you haven't checked that out, it's really a series where we kind of dive into underwriting and we get into his Excel model. So we kind of do a little bit of A, a little bit of B, talking about the fundamentals and actually showing you how to do it. So check those out too. Today is not that episode though. We are just going to be talking about some of the COVID related situation going on. So with that, Rob, welcome on. And yeah, I guess we'll kind of start with, well, first off, how have you been doing? Going okay through all this?
Doing all right. As you mentioned, the Between the Sheets, we do that in person, which is a luxury right now. And I definitely miss that being in New York. I'm in Texas right now. And I think we're going to have to do, like you said, Between the Sheets. We'll have to do one just over Zoom because for those who haven't seen it, we usually get to be in a nice in-person interview style, all that stuff. So yeah, looking forward to getting back to that.
Yeah, we'll have to figure out how to do that. Yeah, like over the Zoom or whatever, instead of like you said, just together. Nice and comfortable, and it looks a little nicer too in person. But yeah, we'll figure that out. So stay tuned for those. So yeah, I guess let's just kind of get into it, Rob. The COVID related issues, and I guess doesn't necessarily have to be issues, but how I guess have you kind of seen the market shift just based on the last month or so?
Yeah, so it happened really quickly. And we have been experiencing the changes in the market from many different sides, from one side as a buyer, from one side as a seller, from one side of seeking debt financing. So all those things have changed massively, as most people have seen. From the buy side, we had to actually terminate a contract that we had under contract for a while. We were prepared to close. But just due to the uncertainty of what's to come ahead, we felt it was best just to walk away and regroup. And so that's a really tough thing to have to do, but it definitely taught me a great lesson of patience and maturity. When you're just focused on acquisitions, you're deal, and you can sometimes just get the blinders on. No, I just want to close. And that's definitely not the best way to be if you're, really in the business of buying and managing good deals. That's on the buy side. On the sell side, we saw that early on in our sale process, we had a lot of demand, a lot of interest, like most sales do right now. But then once the travel ban started kicking in, people started having a harder time to travel, tour the property, and so that really hurt interest in general. Because even if somebody's interested, they can't necessarily tour. We actually had another deal that we were in process on, and we just couldn't come out and do the due diligence, right? With a stay in place or shelter in place, can't go inside, knock on everybody's door, and do a full tour of everyone's unit. But that's putting the residents at risk and the employees at risk. So it really halts transactions right now. And so we saw that from both the buy and the sell side, as I mentioned. And I think a really important thing is how the terms of contracts are changing, right? It's going away, at least from what I've seen, and timelines are extended out, financing contingencies. So it's really flipped quickly from being a seller's market to, I can't say it's a buyer's market because prices haven't adjusted to reflect fundamentals. I still think sellers are seeking yesterday's prices, us included, right? We're not all of a sudden willing to discount our sales 10, 20%, right? So I think the market has yet to shift to being a buyer's market just yet.
Yeah, I would say I agree with you there. reflecting on prices, yeah, not much has changed. But as far as the negotiation leverage, it is definitely kind of trading hands at this point, and will eventually, I think, would see a reflection on those prices to go hand in hand with that. So you mentioned contingencies and contracts, and you mentioned that you walked on a deal. I don't want to necessarily get into too much that you can't disclose, but maybe we could talk about how you got out of that deal and what reasons why you backed out. Obviously, the market uncertainty is a major one, but if there was anything specific on it that really kind of scared you away because of that market, that we could talk about.
So I think the thing that we need to, for good or bad, you have to be aware of who your investors are, and it would not be something that you want to do, which is pushing a deal onto investors in a climate like this, especially without a price adjustment. It's one thing if you had a deal under contract and then all of this stuff started happening and then you got an appropriate price reduction, then you could responsibly go back to your investors and say, we think we've got a discounted price that's reflecting the worst terms on our debt or our projected collection loss for the next 3-6 months. But otherwise, it just doesn't really make sense to go in with no change at all. I mean, values have changed, certainly, maybe just in the short term. So, and another one of your questions, as far as how we got out of that contract, we were prepared to fight. As obviously, we had hard money in the game, like every deal. And it's so funny. We've been saying hard money so much that it's almost impossible for me to say refundable deposit, because I'm so used to saying non-refundable. And all of a sudden we're talking about different deals and I'm saying, oh, that deposit's refundable. That sounds so weird. But yeah, so we were prepared to fight for our hard money. And our attorney just basically sent an email out saying, due to unprecedented circumstances with COVID, we of course have to terminate. And there was really no fight back, and there was an understanding there, and so we were able to get our money back.
Yeah, it sounds good. It sounds like you were able to get out of it pretty cleanly. So I guess kind of moving forward, what is kind of your strategy on the acquisition side? You talked about protecting your investors, and that's a huge thing, right? You are syndicating, so if you have people on a limited partnership basis, bringing money in and that's their only role, they're not able to operate with you and mitigate the risk that way. So the way you can mitigate risk for them is to basically not get in to a deal at this point, right? To not assume that risk for them. So I guess other than sitting tight, is there anything you're doing to kind of prepare for what may come?
So we're just trying to build relationships as much as we can. That might be our existing relationships with brokers. Also reaching out to lenders that we think may have bad loans on their books or loans that are at risk, and we want to be top of mind if they're going to be foreclosing and looking to transact. So that's something that we're thinking about and somewhat planning for. We think it's very early especially from our conversations. Nobody's really foreclosed on anything yet, and there's not much distress out there, but we're anticipating that, so we're trying to prepare for that. And like you said, just pretty much sitting on our hands. There's just not that many smart things to do in terms of new acquisitions for real estate. But I think deals that make the most sense right now are better quality assets, better markets with loan assumptions. Some of the best deals would be something that doesn't have debt risk, because interest rates, even though index rates such as the 10-year treasury has gone down substantially, just because of the supply and demand fundamentals and the uncertainty, spreads have blown out, and interest rates are actually higher, all-in rates. So that obviously, when you're DSCR constrained, which is debt service coverage ratio, which maybe that'll be in our next Between the Sheets.
Nice plug.
Right. So obviously, when you're debt service constrained, any increase in interest rate doesn't just hurt you from a cash flow perspective because more money's going out to debt service. It also cuts your loan proceeds, which then forces you to bring more equity to the deal, which then dilutes your return. So right now, just given where we've been for the last few years in terms of low rates and high valuations, every little move in all-in rates really has a major swing in returns. So if you don't have to have exposure to the current capital markets because you can assume an existing loan, then you're looking in really good shape.
Yeah, that makes sense. The only thing that pops in my mind with that is if you're assuming a loan, obviously the term is shortened compared to if you wrote an original loan. So I guess would you just be looking for longer term loans that started at a 7-year or a 10-year even? Would that be the way you kind of mitigate that risk to be able to make sure you can execute the business plan?
That's actually a good point. It's that what you just said has been our strategy, one of our strategies for a while now, as we've been looking for ways that we can buy deals for a discount. And obviously you can't get anything for free most of the time. So when you accept a discount on pricing, it may be due to assuming a less than favorable loan. Like you said, might have been a 10-year loan when it started its life, and then the IO period of 2-3 years burned off, and now there's maybe 5 or 6 years left, and it's amortized, which makes the debt a little less attractive to a new buyer. Buyers are always looking to come in and get some healthy cash on cash and things like that. So those deals have been out there, and we've been looking for those, and we've been fortunate to get our hands on one or two of those types of deals, and they're still out there today. So the question is, are those sellers desperate enough that they're looking to sell at a discount right now? Which they're most likely not, because if they have an assumable loan in place, like you said, maybe 3, 5, 6 years left, and they have the luxury to ride this thing out.
Yeah, and it's interesting you talk about, not getting in on that interest only period, which obviously reduces cash flows, but potentially we could be seeing something where you're, buying for not necessarily pennies on the dollar, but, a good deal on paper without needing the value add component, which could kind of cancel out that interest only debt that you could have been accruing. So I'm sure we'll see scenarios where it could still line up to be that the debt service will be covered pretty well, obviously deal dependent, but that's just kind of one way I see that could kind of go. I don't know if you have any thoughts on that either, as far as the cash flows for these kind of buying on the cheap.
Right. I mean, if we do see further dislocation and transaction volumes down, on performance deteriorates, then we'll start to see stress sellers and people now taking discounts. And I think you will be able to get value add like returns from really stabilized assets. So not to say that when deals are at a discount, that value add is not a good idea. You may still be able to get a great deal on a value add deal. It's very deal dependent, like you said, but it is something that we're interested in because we have just seen elevated pricing for value add as well as for core plus, and so we'll be looking at going up in quality a little bit to given the discounts.
Yeah, that makes a ton of sense. Yeah, you can play a little bit of both sides as long as you're doing it properly. So let's take a second and flip the script, Rob. Let's see what you're kind of going to be doing on the operational side to make sure you're not one of those sellers that are, in hot waters and got to sell at a discount. So what are you kind of doing to tighten the ship? And I know you talked about kind of due diligence on the property. So how are you kind of handling, keeping operations the same at this point?
Yeah, so that's first and foremost, most important thing. You have to take care of your legacy,
protect what you got,
legacy issues, and then go after the new opportunities. Exactly. Yep. So you don't want to be distracted with your existing stuff when the opportunity arises. So we are doing much of what everybody else is doing, which scaling back on non-essential expenses, and that is especially repairs and maintenance. That's pretty much limited to only life-threatening maintenance requests or other repairs, maintenance that are required on the property. We're pursuing the different SBA grants and loans and payroll payment protection, whatever that's called. So we're pursuing all these avenues, trying to really, the key is liquidity, and just to have enough cash to make it through to the other side. So we're fortunate that on some of our deals we have ample reserves. Other deals we're running pretty tight, and so we're taking extra measures, extra precautions to just make sure that we can, cover our expenses and keep the ball rolling. So I think something that is potentially a little counterintuitive is if you have an agency loan on a property, right? Fannie Mae, Freddie Mac, that means you can't evict for 120 days. So, and similarly, residents know that you can't charge late fees in a lot of circumstances. And if you had 100% occupied property that was backed by an agency loan, you may just have your physical occupancy may not drop off substantially. Economic could just drop, right? And you're really helpless because you can't cycle out those tenants and try to bring in new tenants, right? You're just stuck because your physical is staying the same, but your economic drops. So in those circumstances, we would actually prefer to have lower occupancy so that the residents that are still out there looking for a new apartment, maybe they're trading down, maybe they're just in the process of moving for whatever reason, it would be a safer assumption to bet that people that are moving right now are more COVID resistant. If they feel they have the confidence to put a security deposit down and pay some upfront fees and get into a new lease today, they may likely be some of the tenants and employees that are more in. So I think it's more than ever, it's always super important, but more than ever right now, marketing and attracting new tenants to the extent that you can bring them in. So we're doing things like virtual tours and getting on Zoom with our prospective residents and answering all the questions that they may have, and trying to work with them to make them feel comfortable and safe to either do a self-guided tour, a virtual tour, or if they're comfortable, do an in-person tour, and just so that we can try to keep this activity up as much as possible.
Yeah, that's an interesting point you brought up. Just talking about people having the confidence to move are likely, economic resistant at this time, or think they are at least, right? They think their job is pretty secure. And that makes sense. I mean, yeah, you probably, with all the protections they just released on these renters, they probably wouldn't, feel confident enough to move if they didn't feel like they'd be able to pay the bills. So I guess, how do you balance that between the people that are kind of sitting put? Are you enticing them to leave if you can have the opportunity to entice them to do that? How are you balancing that to be able to fill those other spots with, these new people hunting for property?
Yes. So based on the way our portfolio looks, we're working with all of our residents on payment plans, and different properties in different markets are affected differently. Pretty much all of our properties are behind in terms of collections from this same day last month. But that could also be a temporary thing, as people know they're not gunned by the usual late fees. And so we've been getting feedback that people usually have more of a fire under them, and they want to pay on time because of late fees, and there's just no reason to pay on time right now. And another thing is the messages that we're sending to our residents, just because we're trying to work with them, be friendly, our messages are far less aggressive in terms of, hey, you need to pay. It's, we're not using any of the big guns right now. So that could be driving the difference between this month and last month in terms of mid-month collections. So we'll see at the end of the month how that works out, because of the delinquencies, only a small percentage are actually people that have come to us and explained their hardship, and we're working with their hardship and setting up payment plans. And so we're doing that across the portfolio. We definitely want to work with people. And if people have leases expiring, we want to allow them to extend month to month, which normally there's a month to month fee, which makes that not very attractive and pushes them in the direction of a full renewal. It's letting people go month to month with no fee.
Yeah, that makes sense too. I mean, essentially, it's a matter of not only looking out for everybody, but you're in a position where you need to be able to take care of them, yourself as a business. So however you can accommodate at this time, I mean, it just makes the most sense. As far as I've seen some and heard some kind of talk about, being careful with your concessions, because it could paint you as a bad actor in the eyes of the lender. As far as, you're not trying to collect. So that's kind of putting you in a position to not be able to cover your debt. So how, I guess, are you kind of stepping through that and also trying to take care of your tenants to make sure that everybody's kind of keeping happy at this point?
Yeah, I think the most fair way to do that, the best way to approach that, is just to work on a case by case basis, making property wide announcements, which can then be misconstrued or taken advantage of by certain residents. Just really working with people on a case by case basis, I think, will result in the best outcome. So, yeah, unfortunately, we didn't have a whole lot of preparation or practice for something like this, and so we're learning on the go. But we're trying our best to implement best practices. And in terms of the lender, we definitely recognize. I mean, there's been a lot of talk. I mean, we're all on Facebook right now. I mean, think
Yes.
everybody who used to go on Facebook for just 15 minutes a day, now they're on for 2 hours a day. So we're all seeing people talk about, oh, I'm going to take forbearance. I don't have to pay Fannie. I don't have to do this, and I'm going to get a free ride, and it may be forgiven. So there's a lot of rumors and a lot of talk. And I think the reality is that forbearance is really a last resort tool. And personally, I just not really interested in going through that process unless and from what we've got, the feedback we've gotten is it's not going to hurt you negatively from a credit perspective. If you're a guarantor on a loan, they're not going to, everybody's going through this crisis. So if you're going to have to forbear, and then in a year from now you're seeking new financing, and they'll say, oh well, during COVID you had forbearance, that's a X on your credit. That's not the case. So basically, with all that being said, I mean, we're still looking at it as a last resort.
Yeah, that makes sense as well. And you've mentioned a couple times now, a big thing is just kind of the communications with the tenants, just kind of, putting out that olive branch to see if they want to grab it. So what does the cadence look like? What does the setup look like, especially now that we're all remote? Are you having your property managers kind of just continually kind of nudge these people to say, hey, we're here if you need us, type of thing?
Yeah. Text messages out and notices out. However, we're normally communicating with residents. I think we're definitely communicating more so than normal, or more often than usual. But like I said earlier, the tone of the message is definitely different. Where normally we're kind of just gunning after collections. It's a little different tone now.
Yeah, and this probably doesn't change much for you either. But what does the relationship look like with your property managers now that you're kind of working through this COVID issue? I know you're obviously most of your properties are in Texas, and you're based out of New York like myself. So I probably would imagine not a lot's changed, but has anything changed as far as the communications there other than just heightening to make sure everything's kind of taken care of?
Well, so something interesting, which is affecting pretty much every single owner of real estate across the country, is this payroll protection program. Because for the most part, real estate partnerships and single asset entities are set up with property manager and an owner entity, so two separate entities, and the management company is the one that actually employs the on-site staff, and the owner is just a holding entity really, and doesn't have employees at least directly on site. So every owner across the country has to deal with this dilemma of, how do we apply for the payroll protection benefits if our property, the single purpose LLC that owns the property, that entity itself doesn't have a payroll, but it is actually the one paying for the on-site burden. So there's just with a lot of people trying to get clarification on what the approach is. Does the ownership entity apply and just assume that payroll is theirs, or does the management company need to apply for you? And so, I mean, if you think about the Lincolns and the Greystones and the Pinnacles of the world, they've got 100,000 units, 400,000 units under management for hundreds of thousands of different owners. People are going to be these management companies are going to be really busy fielding requests from different owners to apply on their behalf for these payroll protection grants. And then there's the liability issue. What if the property management company gets that loan in their company name for this property, and then that property subsequently fires that manager, and then that management company is on the hook for repaying that loan? So there's just a lot of crazy stuff happening there. And for that reason, we're working through the issues just like everybody else, but I think it's a benefit that we have a smaller management company. So obviously they're not like Lincoln or Greystone working with thousands of different owners they're trying to satisfy. So we're working very closely with them on that. And like you said, we're just communicating on all of the fronts.
Yeah, it's really interesting. It's kind of a balance of you're essentially just subcontracting out these people, right? They're working for you, but they're not on your payroll, even though you're paying them. So it's coming out of your pocket, but you also don't have them on your books at the same time. So it's how do you get the relief, and do they even qualify if it's under a different property management company? So yeah, a lot of things there. That's really interesting. So
also, a lot of these national management companies have more than 500 employees, and then
that's what you talk about. Starting up Lincoln, it's like, yeah, they're huge. So do they even qualify? Yeah.
Yeah. So it's super crazy because if let's say I'm a mom and pop owner, but I have hired Lincoln or Greystone or any of these large national names, I'm a small business, right? I'm who's getting hurt the most as a let's say just a family ownership company. And yet Lincoln, my management company, may not be able to apply for the payroll payment protection for my small business. And even if you are set up as an owner operator, if you're vertically integrated, where you own and manage your own properties, you're likely set up to do that in the same structure as if it were third party. You would have a management company, LLC, that would be your manager across your portfolio, and then each individual property has a single purpose LLC. So even people that manage their own properties, self-manage or owner operator, still have this issue.
Yeah, very interesting. And yeah, you started to mention Lincoln. I was like, well, at that point, if they're going to be the ones applying, how are they going to get over the hurdle where they're not the owners and therefore even eligible? But yeah, you mentioned like the mom and pop, especially when you get to that small of an owner, it's interesting because they want the relief like you talk about, and I wonder what the balance is. I just personally, and it's not a professional opinion at all, but it seems like it should be on the burden of the owner of the property to make sure all the paperwork's put through, and somehow it gets qualified because you're the owner and it's a small enough business as the owner entity that gets pushed through, and that way you can make sure you yourself get taken care of. Like you said, it's coming out of your pocket one at the end of the day. So yeah, very interesting dynamic though. I guess, is there anything else that's kind of been surprising to you through these times that you kind of want to bring up? Obviously your personal life's changed a lot, but what is the dynamic shifted on the business side? Anything else we haven't really struck on yet today?
Well, we've been really, with the extra time, not focused just massively on acquisitions. We've just been looking at our existing processes, systems, and just trying to find ways that we can do better, improve certain processes, add new marketing features and different things like that. So we've been really evaluating what we can build. And so we've actually, through this period of time, we've thought of and discovered some great projects that some are maybe month-long projects, some are maybe year-long projects, but we're pretty excited about what we're setting out to build and what's going to be in the works. And I'll plug also, with this extra time, I've finished my upcoming book, The Definitive Guide to Underwriting Multifamily Acquisitions.
Very nice.
And I'm really excited about that. So, I'm sure we'll figure out a way for your listeners to get a discount code and get involved and however we can do that and get some bonus content out. But I'm really looking forward to that. I think that's going to be something that I'll look back at this period of time where I'm just kind of stuck sitting around doing a lot of writing and be like, yeah, that's when I, wrote my first book.
Yeah, that's awesome. I'm going to want a signed copy for sure. I'll buy it if I have to. I want you to sign it though. And if you can believe it, to the listener, Rob is probably a better speaker than I, but he's an even better writer than he is speaker. If you've ever read any of his content, he's pretty well versed with the pen or the keyboard. So definitely check that out when it comes out. Yeah. Awesome, Rob. I really enjoyed today. Always a pleasure to have you on. And last but not least, just in case they haven't heard you on before, how can they reach you today?
Yeah, so you can find out more about what we're doing at lonestarcapgroup.com. And right there on the homepage, if you drop your email, sign up for the newsletter, you'll get a bunch of content from me, bonus content, copy of my underwriting model, which is very popular. And hopefully, if I don't procrastinate too long, by the time this episode goes live, when you drop your email into that newsletter list there, you should be able to get a discount or some sort of special offer on my upcoming book.
Very nice, Rob. Yeah, and like I spoke about Rob's writing skills, that newsletter he puts out is part of what I was referencing, some great stuff. So I recommend subscribing to that. Thanks again, Rob, for coming on. It's been fun.
Thanks.
Thank you for listening. This has been the Making Money in Multifamily podcast. If you have any questions, comments, or would just like to connect, please feel free to check out the show notes for how you can connect or visit longviewacquisitions.com.